Hello everyone, welcome to Nissan Finance. Guys, we're gonna dive in now to the covered call strategy. And this strategy is just a continuation of the wheel strategy. We have done so far the cash secure put introduction, the cash secure put management, and also I've gone through some of the Excel explanation that I use because I received some few emails and some commenting asking about the Excel that I use in the video. And I put the Excel link on the description of this video and also on the card up here if you want to get to know about the Excel as well, okay? And like I said before, this is going to be like a series of video because eventually what we're going to do is I'm going to record or maybe put all the video in a single one from the beginning to end, from selling the cash secure put and getting a sign, holding the shares, selling the calls, getting a sign, closing the circle, and going back to the circle again, okay? So just keep an eye, or you can treat this as well as a single strategy because there's nothing wrong selling just the covered calls. Covered call on its own can be a really good strategy to have. Like all of them when it comes to option, you just need to get the right time, the right risk management, the right position size, and so on. And nevertheless, thank you so much for all the love throughout my channel. I never thought I'll have like 1,700 subscribers. I would love to dream that I could have like 5,000 by the end of the year. Okay, guys, but thank you so much. Thank all the support for subscribing, commenting, liking. I really do appreciate, okay? And for those of you that are new to my channel, I cover crypto, stocks, and derivatives. I've been involved in stocks and options for the past 15 years and the crypto for almost 10 years. Okay, so... And like I said before, if you think my content add any sort of value to you, please consider subscribe to my channel and I'll be much appreciated, okay? But guys, without wasting more time, let's dive into the strategy. The covered call, it's very simple. It's very simple. Why someone would use the covered call? Someone might use the covered call just to reduce risk. Let's say in a long position, I don't know, maybe you're holding like 100 shares, 200 shares, 300 shares of Apple, Facebook, Amazon, or things like that. What you can do is you can sell some calls or do a covered call just to offset some of the losses that you might have during markets pullback, correction, and so on. You might have a share or a stock that you want to get rid of that. My point of view, it's better to sell the covered call because even if you don't get to the level of selling your shares, at least you're going to collect some premium. But of course, there's few nuances when it comes to the covered call. It's not just as straightforward as so many people claim to be on YouTube, because sometimes if you really want to sell your shares at whatever price it is, it's just better to sell at the market price. That's it. In that case, I wouldn't use the covered call. Okay. Some people might use just like a type of like hedging. Okay. Some of the covered call, you need to be careful because if you've been holding a stock, let's say for long term, let's say you have a goal on that stock for 5-10 years, I wouldn't sell the covered call, that's for sure. Okay, because if you bought some shares on a long-term portfolio, for example, I'll never sell covered call. Okay, because this for me will be the downsides. One of the risks, it's not a risk because you're still making money once the trade goes in the money, and it is one of the goals, or the final goal of the covered call is the trade goes in the money, then you're out of the position, then you can just move on. But when you have a long-term goal for a specific stock, I would not sell the covered call. Okay, so guys, go and watch part 1 and part 2. Okay, part 1 was the cash secure put introduction, as you can see here on this YouTube thumbnail. I'll put the links below of part 1. Of part 2, which was just a trade management of the cash secure put, and also the Excel that I went through because I received few emails and some comments of people asking me about the Excel that I used throughout the videos. And the link is below on the description of this video. If you want to find out, just click on the link and you'll get you to the place where the Excel is, okay? But anyway, let's get back to the whiteboard. So the covered call, guys, is very simple. Like you can see here on the chart. If I get a pen here, for example, okay. So whatever the stock might be, I don't know. So let's say that the stock is 100. we can sell a call here, let's say for 110. Selling that call, we're gonna collect, let's say, X dollar. Can be any number from 50 cents to $2, $3, and so on. Okay, it's very, very simple strategy. So our maximum profit here, of course, if the shares will be trading above 110, is gonna be the 110, okay, or 100 where we bought the shares minus 110, and the option will be equals to the premium. That's it. Okay, so in this case, he will be $10 from the share plus $1 from the premium. I'm gonna go through this later on in better details. Okay, the maximum loss, guys, the maximum loss, the covered call has pretty much the same payoff diagram of the naked put. Okay, the same payoff diagram. On the upside, we always gonna be capped of that number that I showed you guys before, which was this $111, which is gonna be 110. Okay, on the downside, our maximum loss if the stock goes to zero. Okay, if the stock goes to zero, these are our maximum loss. In this case here, because we collect $1 per share, and then we paid what, $100 per share, so minus 1, our maximum loss here, it's $99 per share. So if that stock goes down to zero, we will be losing $99 per share. Okay, $99. Of course, in this case here, because we're selling one call option and one call option is equals to 100, we should have here at least 100 of these. Okay, so actually our maximum loss here is 90,900. Just bear that in mind. Okay, so every time you sell an option, you need to have, let's go back here to this white board. Remember, every time we sell an option, we need to have at least 100 shares of the underlying in our portfolio, in our broker account. Otherwise, we cannot, because most of the brokers in the world, the ratio is pretty much 100 to 1. I've seen places like in Australia and some of the countries, it's like sometimes it's vary like 75, 70 to 1, and so on. But in the US, it's 100 shares for one contract. Okay, so in this case here, every time we sell one short call, we need to make sure that we hold 100 shares in our portfolio to be a covered call. Okay, and please, guys, be careful. Do not sell naked covered calls. Okay, in my point of view, in my honest opinion, remember, I'm not your financial advisor. My content is just for education purpose only, but I speak from my heart, and I hope you guys appreciate. Short call is almost like killing yourself. Okay, because you sell something here for 110 naked. Okay, the stock is trading 100. The next 2-3 days, that stock might be trading for $1,000. You just don't know. Anything can happen when it comes to the stock market. So just be really careful. Okay, so in this case here, we use the Starbucks. So our ticker symbol was Starbucks. Our long shares here, guys, we have $100 per share, like I say. Okay, the number of shares, of course, it has to be 100 because the ratio is 100 to 1. Our stock price was trading at 101, so it were probably like $1 already on the green. We sold our short call here at 110. This is our K. Remember, strike price is always denoted as a K. It's always defined to be a K, okay? Our premium here for selling this short option, we got what, $1, and the option has what, 30 days to expire. Very simple concept. Okay, so far so good. And if you are a little bit confused about the notations, things like that, the lingo, just go and watch part 1, part 2, because I go through in detail what is stock price, what S, what strike price, what K, what's P for premium, D for delta, DTE, IVR, all this sort of stuff. Okay, and these videos, guys, is gonna be very detailed. If you are here after something quick and fast and just hovering around. No, I'm gonna go in very detail and slow for a proper beginner can understand fully how to trade the covered call strategy, and eventually, like I said, they will. You can skip the video forward, but I'm gonna take my time here because I want to make sure that you can be a beginner or you can be advanced. You will understand the same. Okay, so in this case here, as you can see, our base cost on that shares was $100 each. We bought 100 shares. So in that case, we spent $10,000 to buy those 100 shares. This would be in a case, let's say, for example, you don't have any shares in your portfolio. Your portfolio is just empty. You just started to trade today, for example, and then you went and bought 100 shares, okay, of Starbucks. And then what you can do is you think, oh, you know what? I'll be very happy to let Starbucks goes for 110. So what you do is you go and sell one short call with a strike price of 110, and you're gonna get paid $1. Okay, that's how the covered call works. Okay, so you got 100 shares, you sell one call. If you have 200 shares, you might be able to sell two calls. If you have 300, 400, 500, and so on. Okay, it's very straightforward. So if you look at the chart here, as you guys can see here on the upside, our premium is gonna be always capped. Okay, this is the payoff diagram, guys, of the covered call. So this payoff diagram here is not just the option. As you can see here, this is roughly 1,100. Why is 1,100? Because our shares, our maximum profit on the shares, it's what? $10. Okay, and the option, how much the maximum profit? It's $1. So our total profit on this trade here, it's $11. Okay, but because, like I said before, the ratio 100 to 1, we have to multiply this by 100, and that's where the 1100 come from here. Okay, our maximum loss, of course, like I said before, if the shares go down to 0, these will be our maximum loss. And of course, our break even here per share will be what? $99. Anything below, we're gonna start to lose money until the shares goes to 0. Okay, in the very end of this video, I'm gonna show you what I do to always make sure at least I put all the odds and the probabilities in my side in order to avoid maximal loss, like the shares goes to 0 and things like that. Okay, there's a lot of products that we can trade, okay, which have, let's say, it's almost 0 chance to go down to 0, because if these products go down to 0, the whole stock market will collapse, and that's something will never gonna happen. Okay, so just keep watching, but go throughout all the video. Otherwise, if you skip, you're gonna be very lost at the end. Okay, so just make sure you watch all the video, because at the end I'll show you what kind of stocks, ETFs, things like that I like to trade in order to make sure that at least I'll have a better chance that the stock wouldn't go to 0. Okay, so the next scenario, guys, will be case 1. Okay, in case 1 is when the stocks is trading above the price we paid, but below our strike price. Okay, in this diagram here, as you can see, that the stock price was trading at 101. Okay, as you can see here, we sold our strike price for 110. So basically, we sold that option out of the money for 30 days to go. Okay, you can see here our stock price is below our K. So in this case here, okay, S, it's smaller than K. All right, and as I said before, which will be out of the money. In this case, what I just said, if the stock price close below our K but above the price we paid, which was 100, okay, that option will be out of the money. And I put a green cross here, or a green plus, because I think this is a very good scenario. In my point of view, this is the best case, because you'll be able here in this case to hold the shares, okay, make money on the valuation of the shares, on the increase in price of the shares, and also the premium. Okay, so in this case here, for example, let's say that at the expiration day, after 30 days when passed, today's DT is equals to 0, there's no more days to go. The stock price is trading at $190. Okay, as you can see here. So basically our S is still below our K, as I just pointed out here. And I put that in green because for me, it's a really nice case. Okay, one of the probably the main goals of the covered call is to just let the shares go. But this one here can be a very profitable, especially if you end up being very lucky to have a product that's trading sideways for a long term. You can make a lot of premium and also money on the shares as well. So in this case here, because the stock price closed at $109, which is $1 below our sold strike price, we will be able to make some money on the shares and the premium. Okay, and this is a very, very, very good situation. So in this case here, as you can see here in the diagram, our shares, the profit in dollars per shares will be what? Will be 109, where the share is trading right now, minus 100, which is the price we pay for those shares. Okay, and how many shares do we have? We have 100 shares. So in that case, we just made $900 just on the stocks alone, because the stock is trading at $190 at the date expiration. And that $900, guys, okay, if you do the rate of return in comparison, how much we invest at the beginning, of course, this is just simple math, it's just $90. I don't want to underestimate your intelligence here, but I need to go through these things step by step, okay? So basically, on the shares alone, we made 9%. And if you annualize that, because we just spent 30 days on that trade, the annualized rate of return will be 109.5, which is amazing, amazing return. Of course, it's very skewed to the website, okay? It's not that easy to get those sort of return per year, but in terms of annualized, it's just great. And if you get 90% in 30 days on a single share, it's just amazing. It's a great, great return, okay? On the options alone, of course, same case scenario, the stock closed 109. We kept our option premium, which was $1 that we received at the beginning. Of course, we sold one contract, which is equals to 100 shares. We multiplied that by 100, which will go what? $100. That $100 in relation to what we invest on that trade was 10K. It's just 1%, guys. And annualized is 12.17. And I tell you what, if you make, in my point of view, my goal, my dream is to pull out of the market anything between 8 to 15% per year. Okay, because I think if someone can pull out of the market anything between 8 to 15, let's say if you get an average of there, let's say, I don't know, 12.5, in this case here, which is 12.17, I think it's just amazing. Of course, it has to be consistent, okay? If you do this every single year, I think you can consider yourself to be a genius, because there's a lot of hedge funds, there's a lot of institutions that cannot even get 5% on a yearly basis, like consistent every single year. It's very hard, guys, to maintain those kind of return. And I think if you can get 8, 9, 10, 11, 12 every single year, it's amazing return. Amazing, amazing, amazing return. Okay, you should be very happy if you are able to pull out of the market those sort of return. Okay, the whole trade together, as you can see here, with the stock closing at 109, how much we made? We made $900 on the shares, okay, which was 109 minus 100, so we made $9 each times 100. We made $100 on the options, so the whole thing together we made $1,000. This is the whole trade combined, guys, stocks and options. Okay, so the rate of return, of course, again, I don't underestimate your intelligence here, we made 10%, which is just 1,000 out of 10K. That's all. Okay, and if we annualize that on 30 days, which was the cycle of the options, that's 121.67, which is annualized. It's amazing, very, very good. But this 10% here, guys, it's my main goal, because like I said before, I think anything between 8, 15 is just amazing, 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 amazing. Okay, the covered call, as you can see, it's very simple. It's very simple. Okay, we still have, of course, like the cash secure put 2 or 3 scenarios. Okay, the covered call, the first one is this one here, where the stock close above our purchase price of the shares but below our strike price. Okay, the next one we're gonna go through now, it's when the trade it is in the money. Okay, it's when the stock is closed above our strike price. And in this case here, it's when the stock closed above the 110, which was our K, or our strike price. I put a green again because some people might think this is a bad case scenario, but the thing is, guys, if you trade the cash secure put on shares, and if your trade end up being the money, and you're gonna have to let your share goes and you complain, don't trade covered calls. It's like I said in the very beginning of the video. Remember, if you have a long-term goal on any particular stock, don't trade the covered call. Okay, because if you want to hold something for 5, 10, 15, 20 years, there's no point to sell covered calls. Okay, because we never know what's going to happen to the upside, neither to the downside. So just don't sell covered calls. People say, oh, you know what, I can time the market, I can sell now, I can buy again. No, you might not. You might get a sign here, the stock will never pull back, it will never come back to your price again. Never, ever. Okay, so in this case here, for me, the covered call being the money, it is one of the best, or probably the main goal of the covered call strategy. It is to get a sign so you can get rid of your shares, keep your money from the profit of the stocks and the premium, and move on to another opportunity or something like that. Okay, or as you can see, we're gonna put together, go back to the cash secure put and start selling puts again until eventually you get a sign, and then you're gonna hold the shares again, sell covered call, and then you're gonna have the whole wheel strategy going on again. Okay, so in this case here, as you can see in the diagram, the stock price closed at 115 in this second case study. Okay, as we can see here, I put in green because, like I said, it's still a very good case. These two cases, when the stock closed above our purchase price of the shares or our base cost, and when the stock closed above our strike price sold, which is in the money, I think these two cases are the best case scenarios. Okay, and you should be very happy if this happen. All right, because in this case here, our option will be $5 in the money. We're gonna get a sign, and we're gonna be obligated to let the shares go for 110, which was our strike price. Okay, and of course we're gonna collect that $1 in premium that we sold an option. All right, so it's very simple, guys, very simple. Okay, very simple. All right, we sold, our K here was 110. Okay, when we sold this thing here, we bought the shares for 100. Now the shares is trading at 115. Right, as you can see here, this is equals to S, this is equals to K. So S is greater than K. The option is in the money. It's the opposite of the cash secure put. Remember, when the S it's greater than the K and the cash secure put, the trade is out of the money. But nevertheless, this is about the cash. This is about the covered call video. So let's focus on the covered call. So in this case here, our option, it is in the money. So let's see the stats. Let's see how much we got in this case. So in this example, guys, where the stock price closed above our strike price, I didn't do the breakdown of each of the options and the shares. I just put them together here. But if you want to do the rate of return and the annualized rate of return for the stocks and the option, you can do as well. It's the same as I did before on the previous slides. Okay, but in this one here, on the shares, we made $1,000, of course, because we have 110 here as a strike price. We paid $100 for the shares, so we just made $10 here. We multiplied that by 100, which is how many shares we have. That's where the $1,000 came from. Okay, the options profit, guys, is always going to be the same as the premium initially received. No matter what kind of strategy you might use, For those of you that are beginners, you can sell iron condors, you can sell credit spreads, you can sell straddles, you can sell strangles, you can sell iron flies, you can sell iron butterflies, you can sell skilled iron condors, you can sell nate put, you can sell cash secure put. It doesn't matter, you name it. Okay, our maximum profit is going to be always equals to premium, and that, guys, is constant, always constant. That variable is going to be always constant, equal to the premium. Okay, so the combined total profit of that trade was $1,000 from the shares plus $100 from the options. So we collect $1,100 when in 30 days, which is the rate of return in relation to how much we have to have in our portfolio to be able to trade the covered call. It's 11%, which is just amazing. Amazing return. Okay, of course, the massive skewed upside return is just due to the profits on the shares. Okay, so this 1100, guys, is the whole thing combined, the profit from the stocks and the options, not just the options alone. Okay, and the shares of annualized rate of return is 133.83. okay, don't forget, if you want to know the breakdown of this, you can just do the breakdown here of the shares and the options one by one. In this case here, guys, if we look at our diagram here, like I showed you before on the chart, all right, can you see here the 1100? This is always going to be constant, guys, always, always, always. Okay, this 1100 here, which is our maximum profit here, which is constant, is when we get a sign. Okay, because like I said to you before, if the option is the stock is closed at 109, this might be a different value here. So in that case, I think was $1,000, right? Which was 109 minus 100. But because here we got a sign, which was one of our main goals of the strategy, we pretty much here achieve our goal, which is to get a sign, get rid of the shares, and eventually go back to the wheel strategy, selling cash secure put. And our maximum profit here, it's always, always, always constant. Okay, will never change. I don't think this is a downside. Some people think that this limit potential in profit is a bad thing, but again, you need to know what you want from a strategy, because if you want to have a massive gains and things like that with a very low probability of profit, I don't think selling option is for you. Okay, although I do believe myself it's the only way to make money when it comes to derivatives. I tell you what, even in futures, well, if you start to buy calls and buy puts, things like that, I don't think anyone can make money consistently. Okay, you might hit some home runs, you might get some couple of call options that you might win, let's say 10x, 20x, but in the long run, you're gonna lose so much, so many times that it's almost unbearable to take, to be honest. Okay, and of course, the loss here, the loss in that case of the strategy, it was if the shares go down to zero. And that's what I'm going to show in the very end, what type of stocks, what things you can do to kind of like at least try to avoid that. But of course, anything can go down to zero. But in certain stocks and ETFs, the probability of that happens, it's very low. Okay, so this is the second scenario. We had the number one, which is the stock closing above our purchase price of the shares, but below the strike price. Which, from my point of view, for me is the best case scenario, because I still like to keep selling calls. I like to squeeze as much out of my shares until I get rid of my shares. Okay, the second one, which was just this one here we just finished now, it's when our stocks close above our strike price, and then we pretty much achieve the covered call main goal, which is the let the share goes. Okay, now guys, we're gonna go through the bad side. Because remember, nothing comes for free. There's no free lunch in the stock market. Always there is like a risk to reward, I should say. Okay, nothing comes for free. Everything has a cost. But don't worry, I'll explain the very end what things you can do to at least put the probability in your favor, at least. Okay, but let's go through which I call the out of the money. Remember, the same case one. Case one, when the stock closed at 109, was also out of the money, but was above our stock price, which was the $100 purchase price, the shares. Okay, in this case here, the stock is trading below our purchase price, which was $100. Okay, because remember, you need to have shares on your portfolio, or at least buy shares at the same time you sell the calls in order to sell covered calls. Otherwise, it will be just a naked call option, which I don't advise anyone to trade at all. At all. Okay, so in this example here, very simple example. In this case here, the stock price, it's closing at $90. As you can see here, our stock price, it's below our K, which is our strike price. This case here, the stock is closing at $90, and we have our strike price, which you sold an option for 110. Okay, remember, this is not the purchase price, guys. This is just the strike price of the expiration date being above our stock price. Okay, our purchase price of the shares was $100. Don't confuse with that. Okay, in this case here, the trade is still out of the money. In some let's say other strategy like the cash secure put, naked put would be a great thing to do, but when it comes to the covered call, being out of the money is good, but anything above your base cost of that share, in this case here, anything above 100, it's amazing. Anything below, we are losing money. Okay, anything below 99, remember, which was our break even, which is the base cost minus the premium, we are losing money here. And I'm gonna go through the breakdown of how much we are losing on this particular trade. Okay, so like I said before, the stock is trading at $90. So basically what? It's the current stock price minus our purchase price, which was $100, times the number of shares that we hold in this particular trade. That give us a loss of what? Minus $1,000. Okay, so $90 current stock price minus 100 the purchase price times 100, 10 times 100, $1,000. So the profit, like I say, on the options, as I mentioned before, is always equals to P, which is always equals to what? A constant number. That variable never change, guys, never ever. Okay, so the trade maximum profit is equals to what? The profit on the shares plus the profit on the options. The profit on the shares was minus $1,000. The profit on the option was $100. That was the $900 come from 1,000 plus $100. Okay, minus 1,000 from the shares plus 100 from the options. Okay, the rate of return on that trade so far, imagine if someone want to close that trade now and move on to something else, or if you just want to calculate the rate of return of annualized loss, would be what? Would be the $900 divided by the amount of money we initially invest in the trade, which is equals to what? 9%. Okay, it's very straightforward, guys. There's no much when it comes to the covered call, especially when it comes to the maths behind the return, annualized rate of return, break even, so on. It's very, very simple and straightforward. Okay, there's not much to be said. There's not much to be gone through, because it's very simple. It's very, very simple. Okay, the only thing that I think is very important, it's with what I'm gonna show you at the very end, in terms of like what stocks to get involved to covered calls, what kinds of ETFs, and so on. Okay, it's very, very simple. The final thoughts on the covered call. The covered call advantage, I should say, is that it offsets some of the risks, because remember, in that case where we sold the option, let's put a blank here. If someone, let's say, if someone only had purchased the shares at $100 and that shares was traded at $90 like we saw in the last example, that person will be losing, in this case, minus $1,000. Because we sold that premium for $1 here, which is equals to $100, we offset that what? By $100. So our loss here, which was how much? $900. Okay, this is one of the good things of the covered call. Another good thing as well, if I erase this, another thing as well that we can see from the covered call is that extra premium. Remember in the first case scenario where the stocks closed at 109? In that case, we made what? We made $90 on the stocks, and we made what? $1 on the options. Okay, so another good thing about the covered call, it's that enhance a little bit more on your profits when it comes to the to trade just upright shares. That's all. That's all the good about the covered call. Okay, and of course, everything which has the good has what? The bad. Okay, one of the bad things about the covered call, it's if you go to the route, if you take the route and say, look, I'm gonna sell covered calls. In that case, there we sold what? One contract. Okay. In this case, Starbucks, which was the stock symbol that we used, if you sell one contract here of Starbucks, you need to make sure that you lock in 100 shares of Starbucks in your portfolio. So basically, you're gonna have to hold on to those shares until you get rid or you deal with the covered call or the, let's say, the short call. That's all. Because you cannot, and I strongly suggest to you, okay, remember, like I said in the beginning, I'm not a financial advisor. All my contents are for education purpose only, but I strongly advise you that don't get rid of your shares and let your options to be naked when it comes to call options. Because if you remember this, remember we had here was we had the shares and we lost what? $900. Imagine if that goes down to goes up to $200 per share, and we don't have those shares in our hand to let it go for 110. You can lose here like 100,000, guys. It can happen. It's very, very easy. Anything can happen when you come to the stock market. Particular stock can go up $100. Look what happened with GME, MC, Nokia, BlackBerry. There's, of course, these are type of stocks you're probably never gonna sell calls on it, but look what happened with Tesla last year. Tesla went up, like went to the moon in like what, 2-3 weeks. Just be really, really careful, because any stock can go 50-100% over the night. Even Coca-Cola, which is very stable. Okay, just don't rely on luck. Don't let luck to play out or to dictate of your profits. Okay, use very advanced risk management. You're gonna come up then much more profitable. Okay, another thing as well, one of the bad things as well, is the cap of the strike price. In this case here, our maximum profit was capped to our strike price, which was 110. Okay, in that case there, where the stock went to 115, remember how much money we made? We made $10 on those shares, which is times 100. We made what? $1,000. In that case, if we didn't have the call option, we could have made 1,500. Okay, but again, we can't think like that. If you sell covered call thinking that, oh my God, look, the share is trading at 115, I could have made $1,500 on my shares. Just don't even start the covered call. You need to be prepared, and you need to be aware that you're gonna have to let your shares go to whatever strike price you sold, guys. And you should be very, very happy, because you collect here $10 plus $1, you collect $11. Okay, out of this 15 maximum profit here where the stock price closed at. It's a lot. It's a lot. And don't worry, you can do this on a consistently weekly basis, monthly basis, whatever it is, because that share might just hover around, let's say 110, 19, 115, 18 for the next 6-12 months, and you can keep selling calls and holding your shares. Okay, so if you don't want to let your share go, like I said, do not sell covered calls. Don't just listen to the people saying, oh, this is amazing weekly income strategy. Okay, it can be, but you need to be aware that anytime you're gonna have to let your shares go for the strike price sold. Okay, that's all. So my final thoughts, I think, in my point of view, I think it's the covered call is a very good strategy to earn weekly, monthly, yearly, or whatever it is income. Okay, but however, like many YouTubers or people say that this strategy can be like a guarantee income, guys. Like any option strategy, nothing is guaranteed. Nothing. As you saw on the third case, when the stock dropped to $90. If you want to hold on to your shares until the stock recovered above your strike price, you might gonna have to hold there and actually pretty much like close or lock some buying power for like 6 months, 12 months. Okay, if your broker, let's say, ask you for 25% of buying power, let's say 2,500, you're gonna have to be able to lock in on that 2,500 buying power until your stock recover. And don't forget, you need to be very careful, because if your stock go very deep in the money, like in that case was $90, you might not find, let's say, any decent premium to sell your next call. Let's say even at $100 where your basis cost is, because you could never go lower, guys. Don't go lower, okay? Don't go lower, because it's just not a good case. Just to finish it off here, let me explain something to you here. Let me get a blank here. So basically what I'm saying is, in this case here, right, the stock price was trading at $90. Our base cost on that shares was what, $100. So basically what you can do is, even if the stock is trading at $90, we can look on the option chain, and let's say that there's a strike price of $100 with the 30 days to go, our DTE, 30 days to go, for a premium of, I don't know, 10 cents. Okay, that's fine. If you are happy that wait for the stock go from $90 to $100 to let your shares go for 10 cents to collect pretty much nothing, that's okay. The only thing you cannot do is, you cannot look for strikes below $100. Okay, let's say to 95, because if the shares recover, guys, above 95, you're gonna have to sell your shares for 95, which is the short call you sold, when your basis cost, okay, it's $99. So in that case, you'll be losing what, $400. Okay, just be careful. Just be really careful. Do not sell calls on a deep in the money covered call, because below your base cost, otherwise you're gonna lock in losses. Okay, if you want to hold the shares until the shares recover, that's fine, but do not sell calls below your base cost. Just hold the shares. Okay, and I'm going to show you now what's the best case scenarios, what things you can do to avoid, or at least to have a probability of having something that have a better chance to recover in the future. It can take 3 months, 6 months, doesn't matter. But some stocks have way better probability of recover than some just nonsense like stocks, like all these meme stocks and things like that. Okay, so just be careful with these, guys. Do not sell call below your base cost. Okay, so like I was saying, there's nothing guaranteed. Don't fool for that. There's no such a thing like a consistent income strategy weekly. It can be consistent, it can, but on a yearly basis, 2 years, 3 years, 6 months, not on a weekly basis. You're gonna go through some weeklies, monthlies in a red until the stock recover. Okay, and my thing is, this is the takeaway, I should say. Okay, for me, the key of selling cash secure puts and then get assigned, hold the shares, sell covered calls, okay, get assigned, go back to the beginning and form the whole wheel strategy. You need to make sure that you pick decent stocks to sell and some ETFs. Okay, and my favorite ETF to sell, okay, the whole wheel strategy, or even cash secure put alone, or the covered call alone, is the SPY, of course. Okay, not just because it's liquid, you can get in and out like with spreads like $1. Okay, very narrow spreads. It's just amazing with a lot of liquidity. It's very good to trade. In my point of view, SPY is one of the best one. And if you don't want to go to the ETF route, and if you want to go to the equity or stocks, guys, things like Facebook, Amazon, Apple, Nvidia, Google, AMD, all these stocks are great stocks to have in your portfolio for the long term. Okay, of course we have IWM, we have BABA. There's plenty like Intel, Citibank, Coca-Cola, Disney, McDonald's. make sure you get stocks that you have in your mind that this company is going to be alive in the next 10, 15 years. And I think those ones that I just mentioned have a better chance to be alive or in business than many of those so-called meme stocks. Okay, so just pay attention, guys. Pay attention. And another thing as well that I'll love if you guys take from this video, and one thing only, guys, is position size. Just be careful, okay? Watch your position size, because if you haven't watched part 1, and if you go through and watch part 1, part 2, this is something that I brag about and I keep repeating myself a lot. Watch your position size. If you want to be a very successful option seller like I am, okay, watch your position size, because it's the common thing between all the people that lose money trading derivatives. No matter if you're trading options or if you trade futures, position size, it's the #1 killer. Okay, guys, nevertheless, thank you so much for watching my content. If you're still here so far, if you think this video has had any sort of value to you, please consider subscribe to my channel. That's the only thing I ask you guys for, nothing else. Okay, but nevertheless, thank you very much. All the best for you. Okay, keep an eye on my channel, because I'm gonna put this strategy together so we can combine the cash secure put and the covered call and holding the shares, so we can form the wheel strategy. And all the best and happy investing.